All right, so today I want to talk about the difference between stocks, index funds, and mutual funds, and my belief on them. So a stock is just that. It's a stock. It's one company that is selling or issuing stocks that you can purchase. You can purchase fractions of these, through like Robinhood or different platforms like that, where like, let's say a stock price is $400. You don't have to buy, pay a full $400 for one share. You can buy fractions of a share, right? So the pro and con of that, the pro is if a stock takes off, you could do really well if it's a high performing stock that outperforms the market. But on the flip side, if that company goes out of business, you also could risk everything. You're putting all your eggs in one basket. Now, a mutual fund is basically a managed fund where they're taking everybody's money and they're managing it by buying and selling different stocks. A group of stocks, a lot of different stocks that they're managing in that fund that you're being paid based off the performance, or you're earning money based off the performance of that entire group of stocks. Now, the pro and con, the pro is you have a professional actively managing that fund and buying and selling stocks and trailing the market and doing all that work. The con is it costs a lot more, like there's a lot of fees in mutual funds, so you have to be careful with fees because fees will eat up your compound interest over time and the growth that you could potentially have. And then last is index. Index funds are basically like the S&P 500, it's 500 of large companies in the U.S. There's Apple, there's FedEx, there's lots of different companies within there, large companies. And by doing a mutual fund or an index fund, you're spreading your bet across a lot of different companies, and the chances of that whole group of companies going under is very, very rare. The S&P 500, if all 500 of those companies go under, we're going to be in a very bad spot in the U.S. So, and on average, over the last 30 years, the S&P 500 has averaged over 10%, which is amazing. I was talking to somebody about making 10% interest, compound interest on my Roth, and they're like, where do you get 10% at? I'm like, S&P 500, there's index funds. So here's a list of the 5 best performing index funds that I found online, and I looked at them, and yeah, they look good, and they're averaging over 10%. So check them out. And again, I like them because index funds have less fees than mutual funds. They're passively managed, meaning they're not actively, moving things around. It's just tracking that index, that set group of stocks, or what's in that portfolio and what you're making profit off of, hopefully. So index funds, low fees. On average, the performance is great. And that's what I like because you're lowering your risk. So I do have a lot of money in index funds. I put money every month in the S&P 500. I think it's just a great place to grow your money. If you go online and look at a compound interest calculator and just look at the numbers of what your money can do for you at 10%, it's amazing, especially when you start young. If you have like a Roth IRA, that's a great tax vehicle where you can put money in it, and then when you go to retire, you get it all tax-free. That's amazing. So over 20, 30, 40 years, if you just have money, trailing index funds that are good performing index funds, millions of dollars right there. So check that out. It's a separate video. But if you have any questions on this stuff, just let me know. Thank you.